So, I'm starting a new channel on money and specifically day trading strategies and option strategies. And you would think I would start with the beginning and I would start with basic stock trading advice and covered calls and naked puts and describing the basics. I might get to that at some point, but right now, today, I am facing a decision and I thought it would be educational and interesting to go through those factors of that decision in a video like this. So my dilemma is I am in a covered call trade right now, and I'm deciding whether I should close it early, whether I should roll it up, roll it out. What are my different options? So this is the in the trade while you're in the middle of a covered call strategy, what decisions you make. Because you could hold until expiry, and that's one decision, but there are things you can do before expiry, and that's what we're going to talk about. So when we're entering a covered call trade, it's pretty straightforward and easy to think about the profit at expiry. Okay, so we think about this, we're buying a stock, we're selling a call on it. What's the difference between the stock price and the strike price? And what's the premium we're collecting? And that's their profits. That's a pretty straightforward formula. But if you're in the middle of a trade, if there's 10 days to go, as it is today, for expiry, trying to figure out what your exact profit is a little bit more complicated. And then whether you should do anything, the decision that we have to make of what action to take is more difficult. So the question I'm facing right now is when to close a trade before expiry, when to close a covered call before expiry. So here's the example. I bought a stock on June 1st, so that is 9 days ago from when I'm recording this. I bought 100 shares. Let's say it's 100 shares of DGLY, DGLY. I paid $1.90 per share. So for that 100 shares, I paid $190. But at the same time, simultaneously, I sold a June 19th $2.50 call for 61 cents. So I paid $190 and I collected $161. So that means that on net, I only paid out $129. Now, at the time I made the trade, I had the thought that if the DGLY stock didn't reach the 250 level, I could just sell another call on it in July and sell another call on it in August, and eventually my adjusted price would go down to zero. So I didn't mind rolling this and not getting called. But what ended up happening was the stock has sort of taken off. So we can see here, before I get too far ahead of myself, the profit at expiry on June 19th was pretty straightforward, $121 maximum. And if the stock went to zero, I would lose $129. And so 121 into 129 is 93% return on capital, and it's an 18-day period from June 1st to June 19th. That's a pretty good return on investment. If you could just roll your money 93% every 3 weeks or every month, then you are doing okay, right? So that's why I got into the trade. Now here we are on June 9th, at the time that I'm recording this. There is 10 days left to expiry, so expiry is June 19th. And the stock has rocketed. It has taken off. I bought it at $1.90, and the last trade of the day was $5.70. So you can see here that it is almost $4, $3.80 a share increase, almost a triple. Probably exactly a triple. The call, unfortunately, has also increased. So instead of 61 cents that I collected, it's now $3.30. So some people look at this as being the downside of the covered call. They say, well, thing is, the stock can take off and you're not going to get the value. So that stock has tripled and you're only getting the 250 for it. You're not getting the 570. And that's a fair statement. The time that I bought the stock, I didn't know that it was going to triple. I was happy for it not to go up, and I was just going to collect the premiums, collect the 60 cents every month. And then in 3 or 4 or 5 months, it would have had a $0 cost basis, and I would be sitting on pure profits. So this is, like I said, what people say is the downside. I don't mind it so much. So where am I at though? So what is the profit today? So to calculate that, you have to say, what does it cost to close the trade? So to sell the stock and buy back the call would cost me $240. I would collect a $570 from selling the shares, and I'd have to buy the call back at $330. But I did have to pay $129 to get into the trade. So my actual profits, as I stand here today, my actual profit's $111. So if we compare my current profit with 10 days to expiry at 111 with the max profit of 121, I only have $10 of potential profits. So 10 days to make an extra $10 is definitely not worth it. I will pay to close this trade and redeploy my capital somewhere else. Okay. Now, why is that? Why is there 10 days to go and only $10 or 10 cents per option of value? That's because the 250 strike with the 570 stock price has made this option what's called deep in the money. And the farther in the money an option is, the less extrinsic value it has. So it's purely an intrinsic value. There's only 10 cents left of this time value, and that's the $10 that I'm waiting for. So it seems pretty straightforward that I can just collect my $111 and forego the other $10 and just move on. And I can do that. The other options, though, is what can I do to make even more money? Is there anything I can do at this point to make more money on this? So I'm going to investigate a couple of those options. First thing I can do is I can just roll it up to a higher strike in the same month. So in this example, I can go from the $2.50 strike to the $5 strike. It would cost me the $3.30 to buy it back, and I would only receive $1.70 for rolling up to the $5. That's $160 it's going to cost me. But I do gain the $2.50 between the two strikes. So I could pay $160 more, and that would increase my potential profits, that $2.50 or $250, if that makes sense. So instead of $10 left to go, I could have a lot more. So if we look at this example, the June $5 call, then it would have a max profit of $211 instead of $121, so another $90 in profits. But my investment just skyrockets, it goes from $121 invested to $289. So more risk, more reward. Extra $100 basically. If you do the math, that 211 over 289 is a 73% return in that 10 days. So instead of making 97%, I invest more and I make a lower percentage, but more on a dollar basis. This isn't super enticing. There's some value. I mean, I would love to receive 211 instead of 121. So if I was going to hold it for 10 more days, I might be tempted to do this. But maybe there's something else. Another option I can do is I can not only roll it up, but also roll it out. So if I went from June to July and went from $2.50 to $5, then I could collect more premium. So I still have to buy back the call at $3.30, but then I would move to the July call, $5 call, and instead of receiving, what was I receiving the other call? Instead of receiving $1.70, then I would receive $2. Let me fast forward here. I'd receive $2.50. So an extra 80 cents to go out an extra month. So I would pay $80. The difference between the $2.50 and the $3.30 is $80. So cost me $80 out of pocket, but I could earn $250 more on July 17th. So if we do that math, then the profit goes from 121 on June 19th to 291 on July 17th. And my loss only goes up for an extra $80. That math is $291 profit out of a $209 investment. That could be a potential 140% return in just over a month, 38 days. So that's actually more enticing, right? So instead of making $111, $121, making $290 is quite more than double. Now I could even go farther. So going out to July makes me invest $80. But if I go out to August, then I only have to invest $10. So what is it worth it to wait an extra 2 months, but I only have to put $10 more to get that $250? Let's do the math on that. So my profit, since I'm only investing $10 more, is now up to $361, and I'm only paying $10 more to get that. So that is a 259% return on investment in 73 days. That's quite good too. Now the downside to this strategy, the August strategy, is that earnings is coming in August. So there is a sort of known phenomenon around earnings. So as soon as the company announces their revenue or their earnings, a lot of the uncertainty goes away. So people are what's called the IV, or the implied volatility, is high because there's uncertainty, and that adds value to the options. As soon as the earnings come, volatility should go down, and then the option prices will be a lot more less time value into them. So now, since I'm selling options, that might be a good thing to wait until after August. But those are my decisions. I can just roll up in June, roll up in July, roll up in August, or sell it now or do nothing. I am tempted to sell it now. Bird in the hand, all that stuff. We don't know. With all these numbers, it's presuming that the stock maintains its value. If the stock was to drop below the $5 strike, then I'm back to the situation where I've collected the premium, and I would have to then sell more options, and this trade will extend. So I'm tempted to sell it. But in the end, I think what I'm going to do tomorrow is I'm going to push the decision a month. So I'm going to cash out of the June option and get into the July option. If we go back here, I think we would see that. I'm going to scroll a little fast here. I think we're going to see that the July option would only cost me $80, but would basically return 3 times that by going from the $250 to the $5 straight. But I do have to hold it for 1 more month, and the stock price has to stay up for 1 more month. Now, without earnings to get in the way, I guess that there's nothing that really get in its way. The company also just recently raised some money. So what a lot of these companies do is when their stock price spikes like this, they take advantage and they go out to the market and they do a private placement where they raise a couple $1 million, $5 million. So I think this company raised about $5 million selling some stocks privately. And that's good. This company needs money, and it doesn't hurt the stock price in this limited sense. It wasn't very much in terms of the overall float that they were selling, only a couple of million shares. So anyways, I think this is my decision. Let me know in the comments if you think it's the right decision, what other options I have. Like I said, this was a real question for me, and I am answering my own question here. So this could be a total rookie move. Maybe this was the dumbest thing you ever seen. Hit the like button, hit the subscribe button, and leave a comment. Tell me, what would you have done? Should I have cashed out, took the money, and run? should I be selling covered calls on such a low value stock or a volatile stock? Totally crazy, perhaps. Don't know. But we're in this together. I'll continue making more videos like this. Hope you enjoyed. Thanks a lot and have a great day.